Hi everyone, welcome to Teachly University, and today we are going to be talking about the price to earnings ratio or PE ratio. And as with every lecture, I want to start with a quote, and this is from Warren Buffett, who said, "The stock market is a no-called strike game. You don't have to swing at everything, you can wait for your pitch." And this is a great quote by Buffett because it really reveals his investment strategy, which is that Buffett, like his mentor, Benjamin Graham, they are considered value investors. And value investors are a very unique group because what value investors look for when it comes to stocks is they like purchasing stocks at a discount. They are looking for bargains. To put it another way, they like purchasing stocks at like 50 cents on the dollar. They look for stocks that the market doesn't recognize their true worth because value investors believe that markets are inefficient and they take advantage of these price discrepancies so that with the hopes that eventually when after they purchase the stock at some point major institutions and investors will recognize the true value of that stock, and then that's how value investors will make that profit, is when the bulls or the big money pours into these companies. So Warren Buffett and other value investors use fundamental analysis to purchase stocks they consider to be selling at a discount. So Buffett and other value investors really do in-depth analysis and research using financial tools and ratios to determine to see if these stocks are selling below their market value. And the value investors, there's certain criteria that value investors look for. One is that they look for companies with a durable competitive advantage or a moat. Imagine back in the medieval times with a castle with a large moat surrounding it, and these castles had these moats to prevent enemies from overtaking the castle. It's the same thing with these companies. Value investors look for companies to have this large moat that prevents other competitors from encroaching in their market space. And these companies, they have this durable competitive advantage because they offer superior and innovative products and services, but they also offer products that can really stand the test of time. For example, like Coca-Cola, which is a big value stock that Buffett invested in. Soda is not really going to change. 100 years from now, soda is still going to be soda. It's the same thing with Wrigley's chewing gum. Chewing gum is going to be around for another 100 years. It's not going anywhere. It's not really going to change. So it's those type of durable competitive advantages that value investors look for, as well as other criteria. And value investors look for companies with solid financials. They want companies flush with cash. They want growing earnings per share, increasing revenue. These are some of the things that value investors look for. They want companies with strong financials that could weather economic crisis or downturns, and also show that these companies are growing and are becoming more profitable as the years go on. Also, value investors look for companies with strong management. They want a strong CEO that's a visionary and someone that has the experience to lead the company into the future. And value investors also think long term. They don't like day trading. That's really kind of the polar opposite philosophy of what value investors have. They don't think in the short term. They think long term, and they look at trends as far as the history of the U.S. financial markets. When you look at long term, U.S. financial markets and the U.S. stock market over time continues to grow and expand. And value investors, more importantly, for the purposes of our lecture, is that they look for low PE ratios. They look for low PE ratios so that can determine or help them determine the value of a particular stock. So Buffett and Graham emphasize using the PE ratio as a way to determine if a stock is underpriced or overpriced. So what is then the PE ratio? Well, to first understand that is that value investing involves purchasing the stock of a company that is considered undervalued based on the PE ratio and other fundamentals. So to stress again that value investing involves looking at the PE ratio and other ratios and other financial tools to determine how to be able to see if a stock is undervalued or not. And as I said, the PE ratio, what does it really stand for? What does it do? Well, it is a relationship between the company's stock price and earnings per share. And the earnings per share is how much money a company makes per share of stock. And earnings per share is a great measurement of how profitable a company is and how much growth that they are currently generating. So one of the things that not just value investors, but I would say other investors look for is a company that's earnings per share is growing quarter by quarter. When you see a stock's earning per share grow, for example, 4 consecutive quarters, it's a pretty good indicator that this stock is, or this company is growing in profitability and has the potential for future growth and profitability. So a higher EPS means greater value for investors. And when it comes to the PE ratio, looking at the PE ratio alone does not tell us all we need to know regarding the value of a stock. As I've mentioned, there's other fundamentals and tools that value investors look for. The PE ratio is just one very important part of those tools. And this is the PE ratio formula. You don't really have to know it because already with Yahoo Finance and if you're already investing in your own brokerage or any financial website, it's going to offer the PE ratio for the stock. You don't have to calculate it, but it's good to know the formula, which is the share price divided by the earnings per share, which gives you the PE ratio. So, for example, if a stock is $50 per share and the current earnings per share is $2, then the PE ratio would be 25. So let's look at these two examples here. We have stock A, which is trading at $50 per share, and stock B, which is at $20 per share. When looking at the PE ratio, we don't just want to look at the PE ratio of that specific stock. What is the average PE ratio for that sector that company is in? And for example, with stock A, the sector PE is 15, whereas stock B, the $20 per share, the PE is 20. So out of these two, which do you think is the more expensive stock? Now, when looking at, for example, stock A, people will think that is the most expensive stock out of the two. However, just because the stock is, say in this case, $50, it's more expensive than stock B in terms of the share price, it doesn't mean necessarily that stock B is overvalued. In fact, based on the PEs here, we can see that stock A is actually undervalued, or at least is actually less expensive than, say, stock B, because you're paying less money per $1 of earnings than, say, compared to stock B, where you're paying more per every dollar of earnings for that particular company. So this is why value investors look at PE as one of the tools to help them determine if a stock is undervalued, because they want to see, because they're looking to pay like 50 cents on the dollar and pay at a discount for every dollar of earnings. So stocks that have higher PE ratios are considered growth stocks. And investors gravitate towards these stocks because they're willing to pay more for future growth potential. So stocks that have generally higher PE ratios usually are these high-flying stocks that have the potential for substantial growth, or seeing these stocks escalate in price rather rapidly. And that's why these stocks are attractive. The problem with growth stocks is that they're also very volatile. These stocks can really jump up and down in price pretty violently, especially if there's economic uncertainty in the markets. And that's where that volatility, not everyone can stomach that. And value investors don't particularly like that type of volatility. So value investors like PE stocks because they're paying less for every dollar of earnings. Remember that 50 cents for the dollar mentality that value investors have. They're looking for bargains, and low PE ratio stocks or stocks that have low PE. That's just one of the indicators that value investors look for when making their investment decisions. And with price to earnings ratios, there's generally two different types. There's the forward price to earnings, which uses future earnings guidance. And the problem with the forward price to earnings is that analysts can underestimate or overestimate earnings, which can make it difficult to predict what can happen in the future. And I've talked about prediction and how making predictions can be a fool's errand and extremely difficult to accomplish. And then the trailing PE uses past performance by the total EPS earnings over the past 12 months. And with the trailing PE using past performance can help us determine how a company is doing, but it doesn't necessarily dictate future performance. So you could see sort of the problems that both the forward and the trailing PE can have. So the PE ratio is just one of the many tools investors use to make investment decisions. And even if you're a seasoned investor and you already know about the PE ratio, it's good to go back to the basics, because when making decisions in such a complex system as the stock market, it's important to just understand the fundamentals, because it's only going to help you make better decisions. So it's good to revisit some of these concepts as you move forward in your investment career, making these decisions. But I think the most important thing, regardless of where you go as far as how you make money in the stock market, and there's a lot of different ways to do it, investing is just one of them, is that you don't lose your money. You don't want to lose your money. There's this saying that, I think it was Buffett who said it, that rule number one is don't lose your money, and rule number two is follow rule number one. And that is the most important thing. You want to do your research, you want to do your homework, and you want to make sure that you preserve your capital so that you can live to fight another day. Even if you have some losses, by preserving your capital, you can be able to weather storms and improve your financial standing. So if you like this video, please go ahead and subscribe. Hit the subscribe button in my YouTube channel. And also you can visit me at my email address. You can contact me at myteachly@yahoo.com. So thanks so much for watching this video, and I'll see you next time.